At BMO ETFs, all our investment tickers start with Z. That's right, Z, not Z. From ZSP to ZEB, we build solutions for the Canadian investor. So next time you invest, consider a Z instead.
Hey everybody, it's Larry Berman here. Coming to you on this Father's Day weekend with, heavy heart, given what's happening in Israel and Iran and the Middle East in general. Father's Day weekend, to me, being a father of three, always coincides with my birthday. It's actually a very, very big birthday for me, where the first digit of your year turns into a new one, and you guys can figure out what that number is. So family celebration, and it's sometimes hard to be happy when stuff like this is happening with all the challenges in the world. I remember back on October 7th, what I said that next week, that this is not going to end until there's regime change in Iran and Hamas, and that risk is removed from Israel. And so there is a strong expectation that while normally trading on geopolitical shocks like this is thought to be very temporary, it is possible that this continues to escalate. Obviously, we'll see that in the next few days, and whether it matters for markets or not in a meaningful way next week. Again, for me, I hate trying to interpret an event like this and what it might mean for investors. Big picture, investors should never really do anything about something like this. But this one in particular kind of could be more volatile than we think, because of the very, very direct influence on what the Middle East means for oil prices. And I hate to bring it back to that, but that's the obvious implication, because that has everything to do with inflation and inflation expectations, and to see how sticky it may or may not be. With that said, let's have a dive into the chart room and see if we learned anything this week. Surge in oil prices when the headlines started to hit last night, just after 7 p.m. You can see the movement there in futures. The spike in the first hour, we never got back to those extreme levels during the active market day on Friday that started trading in North American hours right around here. So that tells you there's a message in there, in that market beliefs, like I mentioned in my opening comments, that these geopolitical things are shocks and not something that's likely to continue and have longer term implications. We saw similar response in a couple different asset classes. When we look at US Treasuries historically, flight to safety into the US dollar and the safest asset class in the world, which would be in a risk-off situation, long US Treasuries, got a little bit of a gap, as you see this overnight here. And then pretty much once that initial gap was seen, long bonds sold off all day. There was a little bit of a bid late in the day, as you can see there. This should remind investors how at risk the US market is to the big beautiful bill, the colossal amount of treasury issuance, what that means for asset markets, longer term, and the inflationary impact of what that means for the long end of the US curve, regarding a spike in oil prices, whether it's a spike or something that's going to last a little bit longer. the Russia-Ukraine war was thought to be, a 2 or 3 week thing. We're 3 years into it, but the market has become, climatized, and policies have shifted in Europe and other places in the world, and we've rebalanced some of those supply chains. So, there really are not a lot of long-term implications here. Regime change in Iran, to me, probably means this thing continues to escalate. It's pretty clear the regime in Iran is not changing their view on Israel's right to exist in the world, and their desire to wipe Israel off the map. So, with that said, and what happened in equity markets this week was very benign. This is the most narrow trading range the U.S. market has seen, since April 2nd, Tariff Day, Liberation Day, whatever you want to call it. So that's in itself pretty interesting message. What does it mean? So I struggle with that a little bit, because I don't believe that equity markets have fair value at this level, given what's going on in interest rates and everything else. Tremendous amount of relief from rollback, expectations that tariffs won't be as bad, but really after last week and what came out of the agreement to agree with China, to me, there was nothing done. Obviously, they don't want a big trade war, but China plays the long game. Trump plays the latest social media applause and what Fox Business says about him, and weighs that as more important. Obviously, he is trying to support equity markets with his social media posts these days, compared to the first few weeks in April, where I guess he learned a little bit of a lesson in that sense of being President Tariff Man. But I don't think any of that narrative goes away, and the pay-fors in terms of the budget demands revenue sources. So it'll be interesting to see how Congress deals, the Senate in particular deals with this after hearing from Bissent this week, and what that ultimately, that revised BBB kind of looks like. But July 4th remains the day. The debt ceiling does need to be lifted. The TGA needs to be replenished. That's going to mean a whole lot of bond supply in the third quarter. And what is that going to mean for asset markets? So I don't think stocks can rally much more. I didn't think they were going to rally much above 5,600 or so, or 5,700 or so anyways. So markets can, surprise us. They certainly have in the last couple of weeks. But maybe we've reached a little bit of a high. I would have argued that we should have seen a bit more downside risk. Where did the money go? Gold has been a big benefactor this week, commodities in general, but the energy markets and the flight to safety. And gold, when you looked at broader commodity prices and what happened on Friday, your economically sensitive ones, like copper as an example of that. And when you think about the consumer demand for food, you see that coffee was down initially on the shock. Sugar was down, so you see a little bit of a demand shift there, meaning that this is probably going to impact the consumer from an economic perspective, given higher elevated oil prices, although still benign relative to where we have been in the past couple of years with oil prices. And then finally, the flight to safety into the U.S. dollar. Here's President-elect Trump. Here's the talk of tariffs. The U.S. dollar strengthens, and really, ever since the beginning of the year, and certainly of late, and what's happened with U.S. exceptionalism thought around tariffs and this trade war, weakness in the U.S. dollar. So U.S. dollar became a very crowded trade. It's unwinding. It will be interesting to see how much more it can go, because right now what you're hearing out of the street is that everybody believes the dollar's at risk here and that, you should be buying Europe. I'm not so sure at this point. To the extent that a lot of those flows may have happened already in the last couple of months, to how much more they can persist. I think U.S. exceptionalism in that sense and the U.S. economy and structure remains the best dirty shirt in the laundry, and I wouldn't give up on the U.S. at this point. But that is the current narrative going on. Anyways, should be a somber and interesting week ahead, and let's hope for the best from a human toll standpoint. So as much as we can, let's just wish everybody a happy Father's Day, and hopefully everybody has some great family time this weekend. And if you're a golfer like me, watch the U.S. Open on Sunday.